Warren Buffett sees history repeating itself, but no one's listening. Right now, he believes we're heading towards another dot-com style market crash, and the warning signs are all around us. In this video, I'll break down the striking similarities between the 1999 and today, the current state of the market and what it means for investors, and lastly, Buffett's strategy for investing at market peaks. Let's rewind to 1999, the dot-com bubble. Back then, Buffett warned that the stock market returns were unsustainably high and predicted a sharp decline. At that time, the market had been averaging 20% annual return. Yet, Buffett estimated that over the next 17 years, it would average only 6%. And people laughed at him, but less than a year later, the dot-com bubble bursted, wiping out nearly 50% of the market value. And Buffett's prediction? Spot on. The actual return over the next 17 years? Only 2.77%. His reasoning was simple. Hype-driven markets do not last. He has seen the same irrational exuberance before, whether in the early aviation industry or today's AI boom. Now fast forward to today, the warning signs are even louder. The Buffett indicator, which measures stock market overvaluation, was at 151% in 1999 before the crash. Today, 208%, the highest in history. And just like the dot-com stocks of the 90s, AI stocks today are being bid up to no price too high. The Magnificent Seven now make up over 30% of the S&P 500, the highest ever bid. An imbalance we last saw in 1999 with 22% right before the crash. And when you dig deeper into today's hottest stocks, the numbers are insane. We're seeing PE ratios of over 50, sometimes even over 100. Meaning, investors are willing to invest and wait over a century before seeing a return. And that level of speculation, a major red flag. Buffett's view of an overvalued market is more of a mindset rather than numbers. First sign, market euphoria and excessive speculation. Investors start ignoring fundamentals and chasing rising prices simply because others are doing it. This is when Buffett's most famous quote applies. Be fearful when others are greedy, and greedy when others are fearful. Second sign, blind faith in certain assets or companies. People start believing that certain stocks or assets cannot lose. Buffett called this the castle in the air theory, where investors buy based on stories and hype rather than actual values. For example, Buffett avoided Tesla, Bitcoin, and other hype assets not because they weren't good companies, but because they were overvalued relative to earnings. Third sign, the no price too high mentality. This is Buffett's biggest concern. When investors pay any price for a stock, believing it will always go up. And that's exactly what happened before every major market crash and what we are seeing right now. So what does Buffett say about investing at market highs? Before we get into that, if you want insights and strategies on real estate cycles, stocks, cryptos, or investing overall, be sure to subscribe to my newsletter in the description down below. Alright, back to Buffett's strategy. One thing to note, Buffett has always said he doesn't predict future market moves. Instead, he focused on one thing, buying high quality, undervalued stocks at a great price. And if he can't find them, he doesn't invest. And that's the key. Buffett never chases hype. If stocks are overvalued, he waits. If prices correct, he pounces on opportunity. Well, there you have it. Do let me know what you think about this issue in the comment section down below. And if you want to see further insights about the market of real estate, crypto, stocks, and the cycle, make sure you subscribe to my channel because I'll be revealing the rest of my findings very, very soon.